Hello, and welcome to the March 2025 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your financial planner, Greg Sykora. Joined with me is my partner, Mark Zavitz, who is unfortunately experiencing webcam troubles, but he is here with us through audio. Today, we are going to cover portfolio performance before we talk about how clients like you, we hope, can shift their mindsets with all the craziness that's happening in the world. So let's get started. So as you can see on this slide, if you've been tracking all the crazy or following the crazy headlines, you might think that portfolio performance would be substantially weaker. Well, as of end of March, or one day before the end of March, you can see that our models are actually performing quite nicely. The very conservative model portfolio is actually up after all fees year to date 1.8%. The conservative model is up around 1%. The moderate model is flat. It's up just barely 0.2% after all fees. The growth portfolio model is down negative 1.3%. And the aggressive growth portfolio is down around 2% as of end of March, and that's year-to-date performance after all fees. So, how did we achieve this relatively good performance? Well, despite the fact that most or all US markets are down, and you can see on this slide here when I compare the major indices, if you look peak to trough, you've got the NASDAQ and the S&P 500. At one point, they were up around 5% year to date. Now, from peak to trough, they're down around 10 to 15%. On a year-to-date basis, they're down 5 or 10%. But those indices, the stocks which make up those indices, in your portfolio and the models that we run, it only makes up around 40 to 50% of your stock weighting. The other 40 to 50% of your stock weighting consists of stocks which are European, consists of Canadian stocks, consist of some small weighting in emerging market. Those stocks across the board are actually flat or up year to date. So you've got European stocks and you've got emerging market and some Canadian stocks doing okay. I mean, flat is not that good, but relative to US stocks, which have outperformed the last 2 years, which are down. And that's what's led most of our model portfolio performance, specifically the growth and the aggressive growth models, to not be down as much. They're globally diversified, and that global diversification has helped. Most of you, though, are not in the growth or the aggressive growth model. Most of you are either in the very conservative, the conservative, or the moderate models. Those models have anywhere between 70, 80% bonds, all the way up to around 40-ish% bonds. And bonds are up year to date. This is the iShares Core Canadian Bond Universe ETF performance. This particular ETF tracks basically all Canadian bonds, corporate government bonds, and that makes up about 3/4 of your bond portfolio right now. And as you can see on this slide, it is up 0.77%. The other piece of your portfolio, if you're in the moderate or the conservative models, you've got around a 5% weighting in gold. And if you are a very conservative model portfolio holder, you've got around a 10% weighting in gold. Well, gold performance has been great. Mark, you like to talk about gold and you've got your finger on the pulse in terms of gold performance and what affects gold. Talk to us about, how gold's been performing recently and what we've seen.
Okay, thanks, Greg. Gold's been on a tear, and we've got year-to-date performance of 17%. probably 1 year performance of 40%.
Yeah.
We put gold in the portfolios to do what it's doing right now, to be a diversifier, to add some value when there's a lot of uncertainty. And thankfully, gold is performing the way we wanted it to. So people are very uncertain about the tariffs and about the global economy. They're uncertain about inflation, and they're uncertain about how to run their businesses and run their lives because we're going through a period of change, and that is causing people to buy bullion, and it's causing it to go up. So fortunately, like you said, the 5-10% weighting in the very conservative portfolio is doing its job. It's helping.
Yeah, it is, and is leading in some cases. When something's up 40, 50% on a 1 year basis, it's a huge driver of the total portfolio performance, regardless of the fact that it's a small weighting. But with that in mind, just one thing I like to emphasize: at some point, this uncertainty will go away, and I think, I don't know what's going to happen, but I think that we could see gold go down. And anything that goes up 40, 50% in a year can also go down that much. Not to say that it will go down that much if the uncertainty goes away. I think we've seen this pick up in the appetite of gold. But I wouldn't be surprised if, when this is all said and done, this uncertainty goes away, to see gold go down maybe 20, 30% from whatever high it reaches.
Oh, Greg, I agree. What? It's not a matter of if, it's when.
When, exactly. So here's an interesting slide I found. Despite the fact that the U.S. stock market is down around 10%, here's the slide I found, which shows how many 10% corrections, that's what those red dots are on the slide, we've had over the last 17 years. It's roughly, on average, if we go back further than this, we typically get a 10% correction every year and a half. This picture would suggest perhaps every year or so on average we'd have one. But if you go back to when we had our last 10% correction, it's been almost 2 years. So it's kind of par for the course that we see this type of volatility. Now, we have no idea if this is the start of something bigger or if it's just temporary. The bones of the U.S. economy, which are primarily the fact that spending remains robust, that the top 20% of the economy are still spending, they're still vacationing, and unemployment is still full unemployment. It's better than 5%. So a fully employed economy is an economy that's at 95% or better. And unemployment in the States is only around a 4% level. Even if that ticks up to a 4.5, 4.6%, that is still a very healthy economy. So the fundamentals there haven't changed. The only thing that has changed is the recession call. There's always a baseline call for a recession of around 15% in any given year. That's ticked up to around a 0.25, maybe 0.3%, but still, it's still a relatively strong U.S. economy. And we know we can't control the market. We can't control how much risk we take. And we should always focus on what we can control. And when we do experience these times of volatility, that's, for most people, that means staying invested and ultimately doing nothing while the market kind of does its thing. It declines and goes through its bout of volatility. Even if perhaps this is the start of something bigger, like a larger temporary decline, all that means is, as we bottom out, future expected returns for every single model portfolio are going to be higher. Here's a funny slide. I found showing Vice President Vance applying some Cheeto dust to President Trump. You know, this is where I remained cautiously optimistic. I thought I'd throw this in there because I thought, it's funny. The markets are off to a terrible start because they don't agree with the approach that Trump is, taking, and that is to, kind of not be business friendly and throw tariffs out there. Why? Well, he is trying to revive something that has so much centrifugal force, you know, so much inertia behind it that it's he's not going to be successful. Manufacturing, and this is US manufacturing I'm showing, but basically the exact same thing can be shown for Canadian manufacturing. Manufacturing is not coming back in North America. Okay. Developing countries such as Vietnam, Cambodia, India, Sri Lanka, China, this is where all of our manufacturing has gone. They've taken over. Even when you consider shipping, freight, they can produce things, goods, textiles at a fraction of the cost. North America and developing economies such as those in Europe, North America, et cetera, we're all service economies now. We don't produce things because there are countries out there, developing countries, that can do it at a fraction of the cost. It's just the way the economy has evolved. It's not going to change. And when those economies, such as Cambodia, India, Sri Lanka, where all the manufacturing's happening now, Turkey, China, when those become developed countries, you know where it's going to move? It's going to move to Africa. And that is going to happen over the next 50 to 60 years. So, this is just the way it's going to happen. He is trying to suggest that these tariffs are going to cause a surge in manufacturing. Well, good luck. And on April 2nd, Trump is releasing his whatever he calls it. I can't remember exactly what his term is, but it's basically his tariff strategy. If it's bad and doesn't include carve outs, and doesn't take into consideration existing free trade agreements, I expect the market to have some really bad days. If it's not too bad, say, 5% tariffs to Canada, 10% tariffs, here and there to Europe, I actually kind of expect the market to rally. So the 5 to 10% correction that we're currently in, we could easily see that reverse. Here's why I'm cautiously optimistic. Trump cares about the stock market. Why? Not because he cares about other people. It's because he himself has skin in the game. He's also quite fickle and, in my opinion, weak to pressure. So if he starts to get pressure from Republicans in Congress, those ones that are holding those town halls where the Republican constituents are showing up and basically like shouting at them, screaming at them, he's going to change course on some of his domestic policy, and he's also going to change course on his tariff policy. It's going to happen, and I could see it all of a sudden changing on a whim. Okay, so if things start to go south, don't be surprised if all of a sudden he comes out and says, "Okay, we're changing things." He's prone to do that. And to all the Canadians out there who are taking part in the quote unquote elbows up, here's an interesting slide I found comparing 2024 and 2025 travel bookings. Travel bookings made through online travel sites that coordinate hotel and airline bookings are seeing demand from Canadians crash. They're down over 70%. But please keep in mind, I think this too shall pass. So this is how we feel right now. The majority of Americans are good people. We like to travel down south, especially the clients, you guys who I'm talking to right now, you love to go down south. And the way we currently feel about them, when the rhetoric changes, It's going to become, we're going to feel positively about them at some point. So this too shall pass. And I hope it passes sometime soon. It might take, who knows, a few months, or it might take a few years. But I bet you at some point in the near future, we'll all be traveling down there and this will be forgotten. So that's it. Thank you so much for listening to our update. I hope you have a great upcoming month of April, and we look forward to delivering our April monthly update at the end of the month. Take care and have a good day.
Thanks, everyone. Thanks, Greg.
Thank you.